Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Thursday, September 3rd, 2020. Sorry, things are a little bit delayed. I had all kinds of system problems at home. Nothing to burden you with, but that's why I'm not in my usual spot, and that's why the video is not at its usual time of all days, right? I'd hoped to originally planned today to follow up on some thoughts I had yesterday about how the volatility curve was a bit unusual, how we were looking at a market that seemed to be more concerned about upside risk than downside risk, and how that's not at all normal. And as a rule of thumb, when things aren't normal, they usually revert to normal at some point. That doesn't mean things necessarily revert to the mean. That can be a difficult and dangerous strategy sometimes, but in this case, reverting to normal meant a skew that and levels of volatility that were commensurate with what we were seeing in implied volatilities in the major index options. And the markets put on a big show yesterday, and we've given back a lot of it. At this point, we've sort of arrested the plunge, at least for now. Some of the buy the dips came in, but it took a bit longer, I think, than people expected. But again, another reminder is we're at levels not seen since last week, Monday, depending on your index. Yes, it's dramatic, but yesterday was a dramatic rise, and nobody really seemed to say much other than, markets really continue to rise. I think yesterday, it's early to call things a blow-off. That's what happens when just you've got this final buying frenzy and it expires in a bad way. I don't think we've seen that. I think you would probably look to see that more as an intraday move where you just gapped up in one morning and then faded in the afternoon. I think this is more standard profit taking, but because things aren't standard, we're seeing a much bigger drop off when you go up, over 1% on the way up. Don't be surprised to see 2+% on the way down. Or in the case of NDX, where you're looking at an index that's up 80% or so in a relatively short period of time, a 4% pullback is not something that shouldn't be on your radar. This is what goes back to what I was saying, and I've been saying, is you need to keep a sense of where your risk tolerance is. If you're playing with house money, so to speak, because you've had good market profits, that's wonderful. Do you want to let them ride, or do you want to preserve some of them? And this is why you need to always keep a sense of where your risk is and where it's going. I think what triggered today's sell-off was just, a lot of market participants got fooled by the fact that Apple and Tesla, among others, continued to rally. And I think that spilled into all sorts of other stocks. And if they're rallying if they're rallying, everything will keep rallying. Today, what we're seeing is profit taking. The problem is the profits are so extreme, the profit taking becomes extreme. So if we step back, we say, all right, this is sort of within the normal course of events. We're looking at support levels, let's say. We've done really, and I'm going to look at SPX here. We've come back basically to the 10-day moving average, which is 34.83. So we're a little bit below that now. The 30-day moving average is 33.75. Now these would be big pullbacks, but that's because the rally has been so sharp and so extreme. That's why you see these sort of pullbacks. NDX, which really has gone parabolic in recent weeks, well, we blew right through that moving average, which was about 11.940 or so. And now, the next stop there in the 30 days, 11.330. So, big moves like this can have big pullbacks. And this is what we're seeing. I'm not going to jump out of a tree yet and say, oh, this is terrible. The sky is falling. It'll take a few more days for that. But remember, September is a seasonally difficult time. Institutional investors start to worry about locking in profits. If they've had a good year, they want to lock it in. And I think this is the kind of thing that what we're seeing now. It's September. You get into September expiration, which will be in a couple Fridays. You have futures expiring. Some might argue that this is the inverse of what we saw in March, which was the culmination of the worst of the sell-off as a result of COVID. Are we seeing the end of the retail flood? that might occur around the quarterly expiration in September. A little early to say for that, but we have seen a tremendous amount of new participation in markets, and unfortunately, markets tend to treat new investors badly at some point. When you have enough people coming into the market pushing things up, generally, you sort of run out of new buyers, new money, and as I've said before, you'll keep hearing, "Oh, the Fed's endlessly accommodative." They are accommodative. They're not pulling the plug on the market, but they're not putting new money in, and they're not putting it in the stock market. And so this is, I think, a normal course of events. It's a fairly ugly course of events, but only if you take the perspective of it was up so much yesterday, it's down so much today. If you take the perspective of medium to long term, this is what you get in markets that have been rising so sharply. It's not yet a cause for concern. Let's see if that keeps going, and let's see if there's some real dip buying here, or if that one of the big risks, of course, is when dip buying fails. Way too early to say that right now. We'll see as the days and weeks go on. Hope everybody's doing okay. Take care. Bye bye.